All right, super quick question. Would you rather have $1 million right now or have lunch with Warren Buffett? Definitely have lunch with Warren Buffett, because then he'd teach me how to make $1 million. Internet memes, stonks, passive income. This is so crazy. I can't believe it has taken me this long to finally do it, but I've unlocked a personal achievement milestone because I've crossed over $1,000 per month in all of 2022 for dividend income. And it's interesting because if you've been following my journey since 2019, you might remember my stock portfolio when it looked like that, and me when I looked like this, back when I was eating ramen noodles. You've changed, Andrei. You've changed. Now, this is just something I've been trying to do since 2014 when I first started dividend investing, because I always thought, wouldn't it just be so cool if I could make $1,000 per month while I sleep? Because I've been to so many countries where $1,000 a month is enough to retire on comfortably, and people have. So I feel like I've unlocked some sort of special retirement DLC map. So in today's video, I want to share with you my dividend investing journey after almost 10 years of doing this, my successes, my mistakes, things to watch out for, and things I've learned along the way. I'm super excited, so let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the dividends. So first, I want to say I have no stock courses for you to buy, no financial information to sell you anywhere in this video, no emails or newsletters to sign up for, no seminars, no webinars. I am not a financial advisor, and I'm not licensed to talk about any of this. But sometimes I do magic and comedy in my videos, and I'm not licensed to do those either. So I guess I'm just a rule breaker. Now, for those of us that are not so lucky to win the mega billion-dollar lottery, this is the next best thing. Now, when I started, I had a really dumb question that I want to share with you that maybe you had at some point too, which is, what if I bought and invested into the winning stocks of the year before? Logic makes sense, right? If those companies did really good the year before, wouldn't they do good again the year after that? Apparently, according to experts, that is a recipe for disaster. So I started with dividend investing instead. So with that said, here's my portfolio. Now, right now, the portfolio value is $678,000, which is crazy saying out loud because never in a million years did I imagine 10 years ago that I would be at this point. I'm very lucky to say this, but this is a lot of money to me. Now, what I'm more interested in is the dividend income. So that is $15,464 per year. Now, here's a neat trick. You don't need to know this, but if you take the cash flow or the dividend income of $15,464 and divide it by the overall portfolio value of $678,000, we get what's called the dividend yield. Now, the dividend yield is the percent in terms of how much my portfolio is paying me. That number is 0.02277. Now, when you convert that to a percent and round up, you get 2.8%, which is exactly what my dividend yield shows. So that's how they get this number. Now, the next one is what's called the yield on cost, which is not important at all, but what it does is it takes the dividend yield, the thing I just showed you, but instead of taking my portfolio value, it instead looks at the principal investment. In other words, how much money I invested, not how much money it's now worth. It's not an important metric at all, so we'll skip this one. Here's a fun one though, the beta number. My stock portfolio's beta number is 0.94. Now think of the baseline number as 1. 1 means 100% correlated or the same as the stock market. And when I say the stock market, I mean this stock specifically, VOO, the S&P 500. This stock's beta number is 1 because it is the stock market. This is what all investors are trying to beat, this stock specifically. Now, if your portfolio's beta number was 0.5, that means your stock portfolio would move half as much as the stock market. So if the stock market goes up 10%, your portfolio moves up 5%. That would be a beta number of 0.5. All it does is it measures the volatility in relation to the S&P 500. Now the question is, why would you want to measure this beta number and how is that useful? The way that I like to use it is I look at my stock portfolio, and if I notice that it's doing worse than the stock VOO, and if the beta number is higher than 1, then I think to myself, I'm underperforming this one stock and I'm giving myself a heart attack. Now, there's nothing wrong with heart attacks when you're investing. Sometimes you gotta risk it for the biscuit. But in this case, if you're doing worse and you're taking the risk, chances are you're just better off sticking to this one ETF and not stressing out for no reason. But if I notice my portfolio is doing better than VOO, and if the beta number is lower than 1, then I'm winning. That's where I wanna be. That is the penultimate of ultimates, the holy of holies. So let me show you exactly where my portfolio is at right now. So this right here is my stock portfolio with Robinhood, and I know what you're thinking,
why is he using Robinhood? Such an amateur.
And it's because I've just always used them since 2014, and I've never had a reason to switch, and believe it or not, they've actually never sponsored any of my videos. I know, conspiracy. So right now, my stock portfolio is up 5.12% YTD, so year to date, which measures from the start of the year. So how does that compare with the stock market, right? That would be VOO. So we can take the range right here from the start of the year to where we are today, and you can see the stock market is up 4.14%. So I'm doing a little bit better. Now, this is actually an incredible start to the year. The stock market averages 6.8% over the last 204 years, accounting for inflation. So the fact that our stock market is already up over 4% in the first 2 weeks of the year is an incredible start. Of course, by the time I release this video, with my luck, it'll probably be down 999%. But the point I'm trying to make is that my own portfolio is doing slightly better while taking on ever so slightly less risk and there's less volatility. Now, I would actually rather have this beta number even lower because I like a linguini soup. No, because I like to have less heart attacks. So hopefully now you understand how the beta number works. I should also say that I am now an endangered species because I have gone over what's called the SIPC insurance limit. What this means is that if Robinhood was to ever go out of business, I would only be able to recover up to $500,000 in cash and stock of my portfolio. This is a problem, which means I have to find a way to lower the value of my portfolio to be within that insurance limit. And I can either sell my stocks to do that, which I don't want to do because that would be a taxable event and I don't want to pay taxes, or I could do what's called a partial ACATS transfer. CATS? Where? Now, an ACATS transfer stands for Automated Customer Account Transfer Service. What it does is it transfers stocks from one broker to another. That's all. It's really simple. You can either do the whole portfolio or just pick some of the stocks you want. But this is a great way for me to transfer some of those stocks to a different broker so I can be still insured and still be safe. Now, this usually costs $100 to do this, but a lot of times other brokers will have incentives for you to bring your money over to them. Now, this information will change, but as of right now in 2023, Webull, First Trade, and TD Ameritrade are all offering to pay this $100 transfer fee for you. The point is, I need to do this ASAP, and you'll eventually have this problem too, so just be safe. Next up, I want to talk about the dividend safety score. Super important because dividends are not a legal obligation to shareholders and they can be cut. A good example is in 2014, I bought Disney stock and I thought to myself, what are the odds that Disney would ever cut its dividend? They've been paying since 1989 for decades now. They would never. But they did. In 2020, they cut their dividend thanks to the pandemic after 34 years of consistently paying out. And to this day, they still haven't paid their dividends. Hopefully someday they will, but the point is, they are not a guarantee. So to prevent this from happening in the future, you could use a time machine. If you don't have one of those, the next best thing is to look at the free cash flow and the dividend safety score to make sure that you're not too greedy and you're chasing a high dividend yield, because any downturn in the economy could be disastrous and that company could stop paying their dividends. Some companies are obviously riskier than others, but that's why it's important to pay attention to. And remember, the price we pay for safety is a lower dividend yield. So now let me show you the dividend safety scores of my stocks. So far, 2% of my income is unsafe, and that would be these stocks right here. Now, this category I'm not too worried about just because it's such a small percent of my income, and I'm not gonna sell these stocks just yet. The next category is borderline safe. Now, this is safety scores of 60 and below. In this category, roughly 2/3 of stocks will be fine even in a recession. So for this one, because it's only 6% of my income, I'm also not too concerned. But where I really wanna be is likely safe, which is dividend safety scores of 61 and above. In this category, roughly 90% of companies will still continue paying their dividends even in a recession, and this is where the majority of my income actually is. Now, here's something really important to pay attention to. Roughly 38% of my income is not rated, which sounds scary. I don't want 38% of my income to disappear, but that's because they don't rate ETFs. And a huge portion of my money is invested into one ETF stock, which is Vanguard's Total Market ETF. It represents the entire US stock market with over 4,000 stocks. And if they did rate this stock, it would probably be rated over 99. Very safe. Chances are the entire US stock market is not going to conspire all at once to stop paying their dividends. It could happen, but very unlikely. So that's the dividend safety score, super important to pay attention to. Next up is diversification. And this is just a measure of how many different baskets you have. You know that quote that says, "Don't put all of your eggs in one basket"? Well, joke's on them. There's no more eggs. There's a national egg crisis. You think I'm gonna put eggs in a basket when I would rather be eating them? This is how bad millennials have it. Even cookie cutter quotes don't make any sense. Anyway, diversification is just a measure of how diversified you are, which doesn't explain anything. So here's an example. Let's say you have a portfolio of favorite stocks like Apple, Google, Meta, Tesla, Amazon, all these great companies you think that are wonderful, but all of those stocks belong to one sector, IT, or the information technology sector, which is tech. That's bad. I would never want to have 100% of my stock portfolio in any one sector, and the general rule of thumb is to not have more than 25% in any one sector. And we saw why this rule was so important in 2022, because tech stocks were absolutely crushed, and on the opposite end, energy stocks did really well. So what we learned is 100% energy stocks, YOLO, here we go, baby. No, don't actually do that, but you get the idea. In a perfect world, each of these sectors would represent 9 to 10% of my stocks. But because I live in an imperfect world, over time, some of my sectors have outperformed the other ones. They've become more valuable, so of course the percentages will move. And that's gonna happen to you too. So just over time, pay attention to it and just make sure that no one sector grows to be too big. But I am actually breaking a rule because some of my stocks represent more than 5% of my income, and that's a rule I shouldn't break. Right now, I can already see that Philip Morris and EPD are two stocks that represent more than 15% of my income. Now, it's not the end of the world, but if 10 years from now, those two companies no longer exist, then that's 15% of my income that could be wiped out instantly. Again, not the end of the world, but it is something important to keep in mind, and I shouldn't rely on that income as much, or at least trim the position and diversify somewhere else. So overall, if I can stick to this strategy and keep all of these rules in mind, here's what will happen to my income over time. So this is one of my favorite things to look at, and this is what hypes me up about the future. Check this out. Shows that my dividend growth rate right now is at 3.4%. If I continue to reinvest all of my dividends like I have, it'll add another 3% for a grand total of 6.4%. Now, if I continue down this path without adding a single dollar, in 20 years' time, I'll start making $54,000 per year. Now sure, $54,000 per year 20 years from now is not gonna be worth what it's worth today thanks to inflation, but that's still a decent amount of money to retire on, especially in other parts of the world. But the way I really like to think about it is, that is 10 years of my life that I spent to create $54,000 a year in income for all eternity. Because remember, this is money that's never gonna run out. So I can enjoy this as a gift to myself, or I can pass it on to my family in the future. And not only that, but the overall portfolio value will also be higher in the future too. But ask yourself this, is 10 years worth of sacrificing not buying shiny toys and living below your means worth creating a lifestyle of freedom in the future? To a lot of people, it's not worth it based on how they live their lives. But all I'm saying is that dividend investing helped me to stay disciplined and focused in my earlier years in a way that other types of investing might not have allowed me to. I also know that there's people that are way smarter out there than me and more disciplined, so I know my own limitations, but this strategy has worked really well for me, and I hope it helps you along your journey to freedom. As always though, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. The links are all down below. Go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching. I'll see you back here on Monday, Friday, sometimes a Wednesday. See you soon. Bye-bye.